India are seemingly going from strength to strength, while Russia are left desperate for some good economic news. It's time for a look at the week ahead with Philip Uglow, Chief Economist from MNI Indicators. So firstly, India released GDP data of 7.3%, yet weak exports and investments may well be a concern. So how do you judge their economic outlook?
Yeah, I think the 7.3% print for October to detect GDP, I mean, that's stronger than most people expected, especially given the poor monsoon, over the quarter. What I'm finding it difficult to square is the strength of the GDP numbers with some of the other data on the economy, which is much weaker. I mean, you've just mentioned things like exports and investment are sluggish. Latest industrial production data was a little bit weaker as well. And our own sentiment data has weakened considerably, with the MNI India Consumer Sentiment Indicator close to a record low, and our business indicator relatively weak as well, and on a downward trend. And so, yeah, all of that kind of makes me question a little bit, how the headline GDP figure, can be so strong. I think in our mind that, we're quite optimistic on India over the longer term. I think, the demographic dividend and gradual reforms to improve the economy, I think they're quite positive. But at the moment, there's very little in the data that I can see, that makes us optimistic over the short term. And I think, if India wants to continue to grow strongly and change, then it needs to accelerate the reform process somewhat and remove some of the structural issues that are holding it back.
Next, Russia will release its trade balance data on Thursday in need of some good economic news, as the country has suffered greatly, not least because of a renewed drop in oil prices. How do you assess economic sentiment at this moment in time?
Yeah, there's very little in terms of good news coming out of Russia at the moment, and that's not maybe too surprising. The economic data is universally weak. It's difficult to see any significant turnaround, not least due to the low level of the oil price at the moment. The people who are really bearing the brunt at the moment are the wider population, and they're faced with very high inflation and high interest rate costs. Faced with this, then consumer sentiment, something that we measure at MNI Indicators, it's been hovering at close to record lows. With the best one could possibly say that it's stabilized a little bit in recent months, but it's extremely weak. And what we're seeing there is household finances under extreme pressure, and price expectations, very elevated. In particular, the volatility of the ruble and the weakness in the ruble is very much a negative from their point of view. They're struggling to access credit as well. And the real issue is the authorities' hands are very much tied to a large extent at the moment. Lower interest rates from the central bank, well, that could provide some stimulus to growth, but at the moment, given the weakness in the currency, the high rate of inflation, there's very little they can do at the moment.
And lastly, US retail sales will be released on Friday on the back of the encouraging news that unemployment fell below 5% last week, though the manufacturing and services sectors are dwindling, with evidence of a deceleration imminent. Just how much of a headache are these factors likely to cause?
Yeah, certainly the industrial sector, that's been under pressure throughout most of last year. And that's mainly due to the weaker oil price, which has hurt the oil and gas industry, and any firms associated with it. The strong dollar as well, that's also hit the core manufacturing sector too. And I think generally the underlying fundamentals in the US are strong. And, there are various headwinds from the strong dollar, current financial instability. I tend to think that the economy will weather them pretty well. I think if we take a look at employment growth, and that tells us much of what we need to know about the US economy, employment growth remains very firm, and that will help to underpin consumer spending this year. Labour market continues to tighten, and we saw the first real sign that wages could be starting to pick up, in the January employment report. And I generally think, there's been a lot of talk about the Fed, whether they were right or wrong to raise rates. In general, I think they were right to raise rates. And barring some sort of catastrophic event over the, coming months, I expect them to continue tightening throughout 2016.
Thank you, Philip. Be sure to check back to see how these market movers develop throughout the week. And of course, check back with Louise Macaulay on Friday for the wrap-up. See you next time.